And a big earnings weeks, Alphabet, Amazon, Uber, Eli Lilly, Shell, so many are reporting this week. We're paying attention to companies experiencing a disconnect between fundamentals and share performance. Let's do that with Jed Ellerbroek. He's portfolio manager at Argent Capital Management. Jed, thanks for joining us today.
Hey, good afternoon.
What drives that kind of disconnect?
Yeah, I think the stock market today is really focused on accelerating revenue growth, number one. And then also, I think the big rally in kind of commodity type industries has been the trend to start the year. You see that in energy, a lot of the commodities, gold and silver, of course. So I think those have been the two big focus areas for investors just here in the first month of this year. It feels like estimate revisions, valuation has kind of been taking a back seat, and that's really lasted for the last 9 months.
Okay, let's get to Meta and Microsoft, which already reported last week. Have they set the tone for what to expect from big tech this time around? I know Meta sort of dropped after reported, even though it did well, and Meta gained, excuse me.
Yeah. I think that Meta's earnings last week provide a pretty good hint of what's to come from Google here on Wednesday afternoon. The digital advertising business is doing exceptionally well. That business is extremely conducive to AI tools, both in terms of reducing cost, but also generating additional revenues, getting customers to spend more time on the apps, click on one or two more ads because those ads are more relevant. So outstanding results from the digital advertising companies. Microsoft showed us really strong growth from their cloud computing unit. So Google's GCP and Amazon's AWS, Amazon reports Thursday afternoon, that is going to show really strong revenue growth as well. And then I think the other thing you can derive from Meta and Microsoft's earnings last week that will apply to Google and Amazon and others too, is continued increases in CapEx spending for data centers. Those estimates, those spending amounts are going to continue to be revised higher. We're almost on year 3 of that at this point.
Okay, so Jed, as you know, investors were looking for that, right? Their return on investment. Are they seeing just the beginning of that in some of these companies? Clearly, it's going to take longer for the others who don't necessarily benefit from the ad revenue, the ad spend there. Is it going to take a longer time for them to see that return? And do you feel comfortable saying it will come?
Yeah, the answer to that question depends so much on what industry we're talking about. If we're talking about digital advertising, absolutely. We are seeing a strong return on AI spending, and you see that in the accelerating revenue growth rates that Meta and Google are posting. If we're talking about traditional enterprise software, no, we are not seeing a high return right now on AI spending. Those software companies are largely maintaining their revenue growth rates or perhaps decelerating slightly. We're not seeing broad-based acceleration. I think that will come. A company like ServiceNow, which reported its earnings last week, is targeting 18 to 19% revenue growth organically for 2026. That closely matches what they did in 2025. But there are some hints that as the year progresses, we will start to see that acceleration. I think that would be great news from investors' point of view. And then if we're talking about the hyperscalers or the cloud computing giants, Google, Amazon, Microsoft, we are definitely seeing accelerating and very high revenue growth rates. So I think there is good evidence of return on data center investment in their case.
Okay, you mentioned software, which has taken a beating down. Do you feel like investors' concerns then are overblown, that concern that AI is going to take over for software?
Software stocks typically trade at high multiples. They have, for a long time. And so if you have a company that trades at, say, 30 or 40 times earnings, what that means is investors are willing to place a lot of value on revenues and profits and cash flows that are 5 or 10 or 15 years down the road. And AI is such a revolutionary change to technology businesses that investors are suddenly not comfortable projecting with confidence that far out. And so I think that's the main reason why we've seen software valuations compress so much. It's not necessarily because investors think ServiceNow is a bad business that's going to stop growing or lose a lot of its customers, or other software companies. It's more that AI poses big questions about what enterprise software will look like, how it will be delivered, 5, 10, 15 years from now. And so valuations have compressed. I think there are a lot of software companies that are going to lose customers and revenue because they're not able to keep up with all the new AI tools that are available to deploy today. But there are other software companies that will thrive and do very well. You just talked about Palantir. They just reported earnings. Palantir is obviously a company that has embraced AI, is using it to improve customers' workflows and reduce costs and make them more efficient. Palantir is an obvious AI winner, and that stock has a valuation that reflects it, trading well over 100 times earnings.
Okay, let's get to Amazon very quickly. I'm just wondering how their retail business is doing. We talk about everything else, and they've still got that retail business. Is it expanding? How's it doing?
Yeah, Amazon's retail business is growing about twice as fast as their biggest competitors, which are Walmart and Costco. Those three are taking the lion's share of all U.S. retail growth. So Amazon growing, 11 or 12% year over year in retail. That's a pretty good result. That compares to Walmart and Costco's 5 or 6 or 7% growth. And then I think what really is going to show up for investors here on Thursday is profit margin expansion in retail as Amazon succeeds deploying robots and also just kind of cutting costs. We've seen several rounds of layoffs as they kind of trim back some of their most ambitious projects. So I think we're going to see really good retail margins from Amazon on Thursday. And then if you switch over to the other side of their business, the cloud computing unit, AWS, like I said earlier, we're going to see we're going to see accelerating organic revenue growth. I think, 23, 24, 25% maybe. The company reported 22% last quarter, if I recall, and it was, I think, 18% the quarter before. So continued acceleration from AWS, I think that's going to be welcomed by investors, but we'll see here in 3 days.
Okay, we will see. Thanks for joining us, Jed Ellerbroek, Portfolio Manager, Argent Capital Management.